You have been doing everything right, maxing your pre-tax 401k every year, watching the balance climb. And at age 73, the IRS hands you a bill you never planned for. On a $1.5 million balance, the government forces you to withdraw roughly $56,600 in year one, whether you need the money or not. That forced income stacks on top of Social Security. It pushes you into a higher tax bracket. And it quietly triggers a Medicare surcharge you will not see coming until a letter shows up in your mailbox. If you are 35 to 55 and you have been maxing pre-tax for years, this is not a saving problem. It is an architecture problem. And the fix is not stopping. It is slowing down at the right moment and tilting towards something smarter. Now let us look at the hidden mechanic behind this. Because the problem is not your balance. The problem is what a large balance legally forces you to do with it. Here's how the system works. Every dollar you put into a traditional pre-tax 401k gets a deal from the IRS. You avoid taxes now. You pay them later. That deal sounds great when you are 35 and in a high bracket. The assumption underneath it is that you will be in a lower bracket in retirement. But here's what that assumption misses. The money keeps compounding for decades. And at a certain point, the IRS requires you to start taking it out whether you want to or not. This is what I call the RMD time bomb. The balance you built over a lifetime of responsible saving becomes a legally mandated income stream at exactly the moment you thought you were free. The mechanics are simple. Under Surcharge 2.0, required minimum distributions start at age 73 for anyone born between 1951 and 1959. If you were born in 1960 or later, the trigger moves to age 75. The IRS uses a life expectancy table to calculate how much you must take out each year. At age 73, the divisor is 26.5. You take your prior year-end balance, divide by 26.5, and that is your minimum withdrawal. There is no negotiating. There is no opting out. You take it and it counts as ordinary income in the year you take it. Let us put actual numbers on this. Marcus is 45 today. He has been maxing his pre-tax 401k since he started his career. His current balance is $400,000. He plans to keep contributing through his 50s and into his early 60s. If that account grows at 7% annually until he is 73, his balance arrives at roughly $2.2 million. He runs that number on a Sunday afternoon and pauses. It feels like winning. Then he divides by 26.5. His first required withdrawal is around $83,000 every year, rising whether he needs the money or not. That $83,000 lands on top of whatever Social Security Marcus is collecting. Above roughly $44,000 of combined income for a married couple, up to 85% of Social Security becomes taxable. The marginal rate on every additional IRA dollar can push well above what Marcus ever paid in his working years. The bracket he spent 3 decades trying to avoid in retirement is now guaranteed by the very account that was supposed to protect him. But that is only the first layer. The second layer is Medicare. This is where most people go quiet because most people have never heard of IRMAA. The income-related monthly adjustment amount is a surcharge the government adds to your Medicare Part B and Part D premiums if your income exceeds certain thresholds. In 2026, that threshold is $109,000 for a single filer and $218,000 for a married couple. If your modified adjusted gross income crosses those lines, your monthly Part B premium jumps from $202.90 to $284.10 per person, for a couple that is nearly $2,000 more per year on Medicare alone. And crossing the next bracket adds another $2,000 on top of that. Here is the mechanism that makes IRMAA particularly vicious. It is calculated using your income from 2 years ago. So if a large required distribution pushes your income over the threshold in 2033, you pay the surcharge in 2035. There's nothing you can do at that point. The bill is already written. The IRS assessed it based on a distribution that happened 2 years before you even opened the Medicare letter. Marcus gets a letter in 2035. His Medicare premium for the year just doubled. He does not remember why. Then his accountant pulls up his 2033 return and finds the RMD that pushed him over the line. The RMD time bomb does not detonate at 73. It detonates on a 2-year delay when you are already settled into your retirement budget, and the surprise is the worst kind. Let me put this on a bar chart so you can see the shape of the problem clearly. Imagine 3 bars standing next to each other. The first bar represents Marcus if his balance at 73 is $500,000. His first required distribution is $18,900. That bar is short. Manageable, likely stays below IRMAA territory depending on Social Security. The second bar is Marcus at $1 million at retirement age. His first required distribution is $37,700. That bar is noticeably taller. It is pressing against the IRMAA threshold for a single filer in many scenarios. The third bar is Marcus at $2 million. His first required distribution is $75,500. That bar breaks through the IRMAA line for a married couple in most scenarios stacked on top of Social Security. The bar keeps growing. All 3 bars are the same person. Same savings discipline. Same investment strategy. The only difference is how long the fuse burned before the bomb went off. Now here's the objection I hear immediately, and I want to address it directly. If the balance is bigger, Marcus has more money. Is a high required minimum distribution really a problem if you are wealthy enough to have it? It is a legitimate question. Here is the precise answer. The problem is not having the money. The problem is losing the choice of how you pay tax on it. With a large pre-tax account, the IRS dictates your taxable income in retirement. You cannot tell the government that you do not need the income this year. You cannot smooth a high-income year against a low-income year. Every required distribution is forced ordinary income at whatever rate applies in that year in that bracket with that Medicare calculation already locked in. You did not lose the wealth. You lost the steering wheel. Here's the stronger version of that objection. Some people will genuinely be in a lower tax bracket in retirement than they were working. That logic holds when income truly drops their retirement. But when a large pre-tax balance keeps throwing off forced distributions year after year, that lower bracket assumption often breaks. And the current tax rates are not permanent. They are set by Congress. Betting your entire retirement tax strategy on a single pre-tax bucket is betting that rates stay favorable forever. That is a bet worth examining carefully. Now here's the second objection, and the one where people overcorrect. Should Marcus just stop contributing to pre-tax entirely and go all Roth? This is where people swing too far. And this is the twist that most retirement content never reaches. The answer is not to flip the switch. The answer is what I call tax diversification. The concept is precise. A tax-diversified retirement portfolio holds both pre-tax and Roth assets, giving you the ability to draw from either bucket, depending on what your tax situation looks like in any given year. If one year is low income, you pull from pre-tax at a cheaper rate. If another year is high income, you pull from Roth tax-free. You control the mix instead of the IRS controlling it for you. Pre-tax contributions still make enormous sense for most people most of the time. You get the deduction today. You benefit from decades of tax-deferred compounding. The employer match is the highest guaranteed return available anywhere. None of that disappears. What changes is the strategy once the pre-tax bucket has grown heavy enough that the RMD math starts to matter. Think of your retirement portfolio as 2 fuel tanks on an airplane. The pre-tax tank fills faster and cheaper. The Roth tank costs more to fill now, but burns clean later. If you spend 30 years only filling one tank, the plane is lopsided. Tax diversification is a deliberate act of feeding both tanks so that in retirement you can draw from whichever one costs less at any given moment. This is not a beginner move. You do not think about this when you are 28 with $40,000 saved. You start thinking about it when the pre-tax balance is heavy enough that the RMD math starts showing up in your retirement projections. For most people in this audience, that conversation starts somewhere between $300,000 and $600,000 in traditional accounts. At that point, the question is no longer just how much to save. It is where to put the next dollar. One more piece before the protocol. In 2026, there is a rule change worth knowing. If your FICA wages in 2025 were above $150,000, any catch-up contribution you make this year must be Roth. That is not optional. The IRS made that decision for high earners. If you're using the catch-up at $32,500 or the super catch-up available to ages 60 through 63 at $35,750, those additional dollars are now going into Roth whether you chose it or not. For high earners, the system is already nudging toward tax diversification. The question is whether the rest of your strategy catches up. If you want to keep thinking through this kind of analysis, hit subscribe. The Paycheck Lab publishes one of these every week, and this is exactly the layer most financial content skips. Now here is the protocol. 3 steps. All of them are executable this year. Step 1 is to capture the full employer match before anything else. Every dollar of match is an instant 50 to 100% return on your contribution. Nothing in tax strategy comes close to that math. If you are not capturing the full match, that is the only number that matters right now. Everything else is secondary. Step 2 is to track your pre-tax to Roth ratio as your balance grows. Pull up your retirement account statements today. Add up everything sitting in traditional pre-tax accounts. Add up everything in Roth or after-tax accounts. Calculate the split. If more than 8% of your total retirement savings sits in pre-tax, and that balance is already above $400,000, the RMD math is worth running. You do not need to act immediately. You need to know the number before it gets bigger. Step 3 is to tilt toward Roth in years when the pre-tax account is already heavy and your income allows it. If your 401k plan offers a Roth option, direct a portion of contributions there. If your income is below the Roth IRA limits, contribute the annual maximum alongside your 401k. The goal is a retirement portfolio where you arrive at 73 with a meaningful Roth balance and a pre-tax balance small enough that the required distributions do not automatically push you into a bracket you never planned for. Here is the freedom reframe. Every dollar you put into pre-tax today is a deferred decision. You are not avoiding taxes. You're scheduling them. And beyond a certain balance, the IRS schedules the rest for you on their calendar, not yours. Tax diversification is the act of taking that calendar back. The person who retires with $800,000 in pre-tax and $400,000 in Roth has something most retirees do not. They can look at any given year in retirement and choose which bucket to draw from. Pull from Roth in a high-income year. Pull from pre-tax in a quiet year. Manage the IRMAA threshold deliberately instead of stumbling across it on a surprise letter in February. Your 401k balance is not the scoreboard. The scoreboard is how much of it you actually keep after the government has taken its turn. And the way you keep more of it is not by saving less. It is by building a portfolio that gives future you the most choices. Drop a comment with where your pre-tax to Roth ratio stands right now. No need to share the dollar amount, just the split. It helps everyone in this community see what the real numbers look like. And if you are 35 to 55 building a tax-smart retirement strategy, hit subscribe. We publish one of these every week at the Paycheck Lab. I'm Caspian. I will see you in the next one.